Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back, everybody. Seems like every week it gets a little bit longer. Right around this time of year, especially when you can't get out that much and can't go to the park and walk and exercise and all that other kind of stuff. Gets very boring trying to stay inside. But I guess that's just par for the course. I was looking at, I get Scientific American, which is it's kind of like Popular Science was, and then there's another magazine called Science Focus, and that's an English magazine. And these things, they talk about new developments that are coming, not necessarily for investment purposes, but just basically news, all the new developments that are out there. And I can remember going way back, I've always done this. You read in the magazines things that are on their way, and it's not very time consuming anymore. You've got so much, the reporting's gotten so much better, but it'll tell you literally a few years in advance what's happening. And I think it's kind of important as your investors to keep focused on not necessarily the near-term future, and that's the biggest mistake I see people make in investing. They're focusing over the next 12 to 18 months as if that's what the average person who doesn't know a lot about investing considers long-term. Yeah, well, that's a long time. Well, guess what? The market doesn't agree with you. The long-term for the market's 10 years or longer. The short term is anything less than 10 years. And that's so disappointing to so many people. And I know, I get it. And when I first learned it, I was like, wow, that doesn't sound all that good. And quite frankly, it's hard. But as markets have progressed, that hasn't really changed all that much. You've gotten a lot fewer stocks to invest in, but still, they're more than any one person is going to be able to hold in their portfolio at any time. But the data that we've got a lot more data. Makes it a lot easier to try to match up whatever your personal goals are with your investment portfolios, and that's a big deal. I look at a lot of the companies over the years that somebody like Warren Buffett, and if you're not old enough to know who he is, look him up. He's done an amazing job for decades at investing, and he's very extremely long term. Actually, he's kind of where the buy and hold, I think, got really popularized. I think that's really dangerous. If you're going to do it with individual stocks, that's not a good idea. But if you're going to do it with a portfolio, that's a really good idea. And I guess today when I was looking around at all this stuff and I see how many different developments are coming, that's what I read this for, by the way, is just to keep up with what is happening in the background. What kinds of things are we talking about? I can't tell you how many times I had people when I was a whole lot younger listening, and all the things that we have now, like the cell phones that can do almost everything. And we all thought that at that point in time it was going to be like a Dick Tracy watch. And if you're not above the age of 55, you have no idea who Dick Tracy is. And probably even those people don't know either. But I'm 62. So I was there. I saw the funnies and the cartoons they came out in the Sunday paper, and Dick Tracy was a really advanced private detective, and he had these watches that he could communicate on. They would look and could talk in like a walkie-talkie watch. Now, those watches do exist, but most people would rather use their cell phones because the screen's a little bit bigger. But my point behind all this is the stuff that you're reading about today is probably what's coming tomorrow. And I don't mean by saying that, I don't mean super quickly. Sometimes they do, and other times it takes a lot longer than you thought it would. And I remember talking about the internet, and I was like, I couldn't believe how long it took for internet to be available all across the country. I just thought that, oh man, they just, the powers that be have got to realize that the demand for this is going to be astronomical, and they're just this thing's going to be here in a matter of 3 or 4 years. That's because I was really young and I didn't have a lot of experience. And my point to this is, like, you can be right on your investing, but the timing might take a lot longer than you think it's going to. And that's extremely frustrating. And it's one of the reasons you have portfolios the way that we do today. And these, by the way, they didn't exist back in those days. There were a lot of tons of mutual funds, and they all had different types of managers. You never really knew what was in the portfolio from day to day. It's not like you can do it today where you just go up and look up the top holdings. And with index funds, which are mostly ETFs, exchange traded funds, the most popular category are index funds. So they'll describe an index, like maybe utilities, could be technology. Those are pretty broad, by the way, broad indexes. But the companies that'll be in those stock or those funds are going to be long in that particular industry group. And you couldn't do that. I mean, I don't even know how many years ago it was, but literally it just didn't exist. So from that standpoint, you have a lot more options, and I feel like you can be a lot more effective today. And you've got other products now that are also very good, that have got so much data behind them. You can have fixed annuities that have a really competitive payout. Depends on your age and when you want to take the income, but they're extremely competitive. They're typically a couple of percentage points higher than whatever your long-term government bonds are or CDs. And if you're not taking the income, then it gets deferred. You don't have to pay taxes on it until you actually start to take the money out. That's a big deal for an awful lot of people. And it's just really, you've got a lot of choices. Making the right choices for you, it depends on how you feel. And I just wanted to go back and cover this one more time. Actually, I'll probably cover it until I die because this part doesn't change either. There are a ton of really good ways to invest, but there's really a good way to invest for you. And the best way to invest for you may not be what the best way to invest for other people are. In fact, I can tell you it's not. Your personality has an awful lot to do with how you should be investing. And one of the reasons that people fail at investing is their style and their strategies. It doesn't match their personality. And there are tons and tons of reasons for that, but that's the main cause. When somebody's unhappy, it's because whatever they're doing doesn't match their personality. Now, some people have gone out and read a little bit, and a little knowledge is a dangerous thing. I'm sure anybody over the age of 50 has seen that. Those kinds of things blow up in almost every aspect of their life. Somebody gets in with just a very little, not enough knowledge, but they're more overconfident, and they make mistakes. So you want to, hopefully you can avoid that, especially when you start getting closer to retirement, because that is tough. You start getting close to retirement, you can't afford a big mistake in your investments, because it could take 5 or 10 years to correct. And that's one of the reasons I'm still doing this radio show, because I'm honest. I tell you what to look for, what to look out for. And I'm a fee-only advisor. It doesn't matter to me what you're doing. I just want to help you define what that is, and then put up a strategy that's going to help you reach whatever goals that you have within the risk tolerance that you have. Now, sometimes, and oftentimes, it depends on somebody's experience, it's impossible to do. If you come in and you want 10% average annual returns in your investment portfolios, but you don't want any risk, well, I'm just going to say good luck. And I've walked out, I've passed an awful lot of business that way. And I could have told them exactly what they wanted to hear. I could have shown them the long-term statistics on almost any stock fund out there. And when you're looking at something that's been around for more than 10 years, it's probably got a really good track record. Otherwise, they don't last for 10 years; they go away. But something's been around for more than 10 years. It's probably got a really good record. So I could just show you that. And when the market crashes and it's down a lot, I just say, well, this is kind of the way that our industry works. One of the reasons that the industry for a long time, people had a really bad impression of financial advisors, and I get it. It was more an industry of commission-based sales. There's still an awful lot of commission that goes on for different products, and some products you can't get them any other way. So if I've got a couple, three annuities, and I had to pay a commission on each one of them. Yeah, I did get the commission, but I just, the insurance company takes a portion of that, so I didn't get the whole thing. And if I took it out, I'd pay a penalty that's higher than the commission that I got. So, it's in there for a reason, because I just didn't want to worry about having to meet my basic living expenses, when I'm retired. And now it's hopefully, knock on wood, it's probably not for another 10 years. And anyway, so when you're sitting down and you're doing this kind of work, it could be done so easily today. And I think, I don't know, I just have a feeling that some people are figuring it out, and it's a good thing. If you really do a lot of studying, you look at it and you go, wow, okay. So stocks are generally, let's just say stocks, if you give it rolling 10-year time periods. What's a rolling 10-year time period? Well, it would be from like 1970 to 1980, 1971 to 1981. The next period would be 1972 to 1982. That's rolling. When you look at the returns on markets over that time period, they're pretty good. The vast majority of them are very good. There are a few that aren't, and it's important that you pay attention to that, okay? Because those declines are not going to go away. Nobody knows exactly what it's going to be in the future. But we've got a lot of really good data now to be able to look at the portfolios and construct them to try to match with our personalities. And what I mean by that, well, I had this question. I still use it. In fact, I've used it my entire career, And it was just, and I've talked about this 2 or 3 times. Most of the big firms finally gave up all those, 50-page questionnaires that they gave you and asked all kinds of questions to try to keep you I think a lot of it was just to CYA and for the firms. And I think I have to take a real quick commercial break here. So, this is Bill Bullington. I'm right here on 1420. Stay tuned. I'll be right back.
Snow is falling again. It looks like a wonderland, but I'm stuck in traffic behind all these red lights. So I call you up inside.
Well, welcome back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon on this station 1420. Been here for since 1996. That is amazing. Actually, it was a different station. It's changed hands. And just mind-boggling how fast the time goes. I know that sounds like such a cliche, and it is. But that doesn't mean it's not true. And a lot of things I thought when I was younger that I had no idea. But good to be here. Good to be around, and still have most of my brain functioning. And that's one of the things that I like about investing too. It's realistically, you have to learn a lot of stuff, but you're learning most of it so that you can know what not to pay attention to. If somebody had let's say you're learning to fly a plane, and there's a dial on that plane, and the dial literally was put there as a joke by your flight instructor, and just to occupy your brain and keep you doing something busy. Well, that wouldn't be too cool, right? You really wouldn't appreciate that, especially when you're 15, 20,000 feet and it's a long way down. And now you're paying attention to something that you really don't need to be and could be distracting you from something that you do need to be paying attention to. Well, investing is very similar to that. There's a lot of stuff out there. Most of it, you don't really have to know that often. It doesn't come up that frequently. It helps if you know, so that when it does come up, then you might know how to respond to it. But realistically, the information that you need on a daily basis is not nearly as intense. I mean, and you don't have to. I talk to people all the time that don't really know a ton, but they feel very comfortable in the knowledge that they do have, which I think is that can be a problem. Overconfidence is as big a problem, probably a bigger problem than underconfidence. If you're underconfident, then you're probably moving much more carefully. If you're overconfident, that's when really big problems can arise. And I wish I guess, I'm going to have to do another seminar. I was thinking that I might go and do one a quarter. I used to do one a month for years. And I'm just curious to see how much things have changed, because I stopped doing seminars when COVID hit, because you couldn't get together. And then when COVID was over, I just never went back to it. But so we'll get one on the charts here. I would like to see an awful lot of people. I haven't seen them for 3 or 4 years. That's mind-boggling. And there's been a lot that has changed. And I'm trying to incorporate new methodologies into what we're offering. So that would be a good help. They're not for everybody. Nothing's for everybody. So that's another thing that's really important. Trying to get to know yourself. What kind of risk taker are you really? Most people look at the returns and go, yeah, that's what I want. okay, well, that particular strategy was down 50% more than once over the last 20 years. Are you okay with that? And if you're not okay, then you probably shouldn't be doing it, because there's no telling when it's going to happen again. And I promise you, sure as I'm sitting here, you'll have another 50% correction or more in the stock market at some point in time. It's just going to happen. And it's just the way that it is. It's always been that way. It's never not been that way. So you have to be careful. You just want to be careful. And you have to make some assumptions. I just figure that only the good die young, so I'll probably be in my hundreds before I die. And just kidding. But anyway, I expect to be here a long time. And my kids, by the way, they know enough to be able to do the same things that I'm doing. Because we've gone over this. I mean, they just ad nauseum before they ever got out of high school. I started working with them when they were in elementary school, and they get it. And I'm going to tell you, it's not the knowledge; it's the psychological mindset. Knowledge is easy, that knowing what to do, not that hard. Doing it, that's another thing entirely. And you got to be diligent. And if you can't be diligent, do what I did and hire help. Let them tell. In fact, we've got a great relationship with. They call it FMAX. It's for advisors only. It's through Fidelity, and I love these guys. Yeah, they're I turned over most of my money to them. And it's awesome. You see what's going on in the news. You see the companies that are in the portfolios. One I think is really interesting is Elon Musk's company. And here goes the senior moment again. But anyway, Tesla's been around for a while, and Tesla, by the way, is not just a car company. They do all kinds of crap. And this guy's got more projects going at any one time than anybody I know. Now, that is not a new concept, by the way. I came up in this industry, and there were these companies, they used to call them conglomerates. And that was the name that they like to use. This is a conglomerate. What does that mean? Well, it means they got a whole bunch of different businesses in different industries that are not really even that closely connected to one another. That's the thing about Elon Musk, is his are all connected to technology. Whereas when I was coming up, you might have an oil company that owned a grocery store chain. What do those things have to do with each other? and that was so you had to read a lot more than you do today and find out what was going in there. And by the way, that's another reason, if you don't want to do that kind of homework, and I don't know anybody that's got the kind of time that it would take to be able to do that kind of homework. And incidentally, I remember reading Warren Buffett way back. I was just a kid. And Peter Lynch, too. Just a kid then, too. Both those guys came out and in writing said that if you can't stand to see the value of your stocks drop by 50% or more, don't buy stocks. I thought they were kidding. I didn't think anybody had the guts to stick out a 50% decline. All my clients, they would pull all their money out. And so I incorporated that. I went right out to them and I started talking about it. I started talking about it here on the radio program. All my seminars started talking about it. Now, here's the other part that they just assumed, I guess you would know, is that, markets are going to move up and down quite a bit. Why do stocks do better than bonds or fixed income? Well, because the companies that are in those indexes are going to increase over time. And some of them are going to do quite well. And when they're doing quite well, they'll be picked up either by the portfolio manager, the rules that are running the portfolio. Those are there are tons of those. And ETFs are actually a public version of that type of portfolio. Instead of having the individual stocks, you're buying a fund that's holding all those stocks, and you never really know what's in it or what the changes are because it happens so fast and they don't report on that kind of stuff. You have to go look that up yourself, and even then you're going to be estimating. So it's tough. If you really want to know what you invest in, what you own, get ready. Roll your sleeves up. If you need glasses, you might want to get a really strong cup of coffee. You're going to be there for a while, but only if you want to do a good job. If you don't want to do a good job, hey, just take a shot. And not how I want to handle my retirement, but that's I'd like to know. I'd like to be prepared, and that's really what the best thing you can do for yourself is being prepared. Have a conversation with your financial advisor. Say, hey, take a look at your portfolio. What do you think? I'm looking at them all the time, by the way, and I invest in the same things I have my clients in. Mine's probably a little bit more aggressive. Not a lot. You'd be surprised. But it's going to be a little bit more than average. I think I'm 70% in stocks, which is a little bit more than average. 60-40 is typical. I'm so glad that interest rates are moving up. You should see if you'd like to make a little bit more than you'd make on a CD or a money market, and at least for now, if you don't want to have to pay taxes on that interest, well, annuities are a good thing. For years, I didn't talk about them much at all because the interest rates were so low that I just didn't think it made sense. Well, now they're pretty good, and it depends on your age. The older you get, annuities kind of work like reverse mortgages. You're going to give them a big lump sum, and they're going to pay you. Okay, so instead of you paying a little bit that adds up to a big lump sum, then one day you get the title to your home. And now it's the assets grown by inflation, and it's worth a whole lot more. At some point in time, I don't know. I've looked at the reverse mortgage. I'm not a big fan of it, but that's basically what an annuity is. You give them a big lump sum, and instead of building up to that big lump sum, now you're taking that lump sum and you're going to spread it out over your life expectancy. And the vast majority of them, not all of them, but a vast majority of them will offer some sort of a lifetime benefit so that you can't run out of money. And then, that's a big deal. It just gives me peace of mind knowing that, hey, worst comes to worst, I can still pay all my bills, all of them. And so I really don't have to worry that much. And I've known that from the time that I started that program. And it's kind of interesting that now that I'm 62, I'm going to try to work until I die, because I don't know what else I would do, quite frankly. And it's not that hard, especially once you've done all the background and research work. It becomes a lot simpler, and then you can identify a strategy that's a good strategy. Like there's and I'm so stuck on this because I really like this fund. It's one of my favorite ETFs, and it's a company called Pacer put it out. I can't name the specific product. We're not supposed to do that kind of thing because there are rules. But anyway, they have this one fund where they're actually looking at the amount of cash that's being generated, and they divide it by the total capitalization of the company. What does that mean? Well, if you bought the entire company, that's what you would pay. You'd buy the shares for the price at whatever they are, times the number of shares, and you would assume all their debt that you have to pay off at some point in time. And you'd subtract out any cash they had that was part of the deal. So, the bottom line is you're getting an estimate of what they used to call enterprise value. I don't know if they even call it that anymore. But essentially what it would cost in dollars to buy out the entire company plus all of its debts. And then that makes you the owner. Okay, so if you took that price, whatever that is, and divided it by the amount of cash the company was generating. Now, there are tons of ways of delineating cash flow. In other words, they've got more than one model to try to calculate how much cash. And then, by the way, if you get 5 accountants to take a look at the numbers, you're probably going to get slightly different variations from each one of them. So you have to guesstimate. You got to do a guesstimate. And that's what you got to get really good at if you're going to be doing finance. And I know this all sounds super boring, and it is, but it's also necessary. Thank goodness, because that's why I have a job. But and these guys they've got a really nice ETF. I love it. I've got a pretty big chunk of it because I know what they're doing. I also know what the portfolio managers are doing outside of that fund that I purchased. And I hired these guys from Fidelity's platform just to come in and manage a certain portion of my money. And I'm just so glad that I have these options available. And these are the same options that you have. And I think the hardest part for an awful lot of people is trying to figure out what kind of investor they should be. Literally. And I've worked with this one particular questionnaire that's been adopted by some of the world's largest financial managers. They used to have these questionnaires that were like, 12 to 14 pages, and they asked you all these questions, and nobody knew if they were understanding the question, but you had to put an answer down anyway. And I just said, this is madness. Here, let's do it this way. Take all your money, all your investment money, okay, and add it all up. Okay. Now, start subtracting percentages. Take 10% off. Let's say, to keep my math simple, let's say it's $1 million. So if it took 10% off, am I losing sleep knowing that I'm investing for the long run, that I'm going to probably try to take out somewhere between 4 and 6% a year over my lifetime, and I think I'm going to live 30 years, at least 30 years. Okay. So if I took out 4% of that, that would be $40,000. Okay. With that mix of assets that I've got there that I'm thinking about investing in, how would that have done over the last 50 or 60 years, or even the last 100 years? Yeah, actually, we can go 100 now, because that would be in the mid-20s, the roaring 20s, right before the Depression. You had a bunch of wars since then. You had massive inflation since then. You had crashes. So I think pretty decent to say, okay, what was the long-term average of that? And let's just take that number as what we might shoot for. But by the same token, how many times had the market been down, more than 30%? And I'm pretty sure it's somewhere around 5. So, and it's averaged, that is averaged happening about once every 20 years. But, if you go back over since from 2000 to 2010, it happened twice inside of 10 years. So again, you can't, there's nothing that you can say that this always happens. So you have to be aware of that. And your own personality is going to have a lot to do with that, because I ran through my mind over and over and over again. I used to say, I bought this software when I was brand new in the business. I didn't have any money. I was trying to build a practice, and I had kids, and my spouse didn't work. So I was commission only. And I'm going to take a real quick break. This is Bill Bullington. I'm right here on 1420 every Saturday morning from 11 to noon. Stay tuned, because I will be right back.
In a one-bedroom apartment,
Welcome back. This is Bill Bullington, here every Saturday morning. Got Christmas coming up this week. That's awesome. Hope you all get to spend a lot of time with your families. And if you're like me, I have a bunch of grandkids, and looking forward to getting to spend some time with them. Won't be able to see all of them because a lot of them are not in town close by, but which really kind of upsetting. But at least we can FaceTime. And, I'm not even sure if they'll have enough time to do that. It's unbelievable how quickly time goes by. I heard this my entire life, and I was always rolling my eyes, and now I know. It's mind-boggling. And so I have a lot of really, really, really good memories, and I hope you do too. I really hope wish you the best in this holiday season. I hope everything goes well for everybody. And I'll be working some of the time, taking a little bit of time off. I'm always working, by the way. You should see the number of magazines I read. And I have a Bloomberg terminal, which is a really expensive tool, and it's for research. And if there's anything regarding finances that you have questions on, it's in there somewhere. Oftentimes I have to call the tech support there. They're 24 hours a day. I've talked to people in England, in France, in China. They have people all over the world that pick up the phone when you have a call, when you have a question. And it's crazy. But it's also one of the resources I used to understand how markets work. And that's such a blessing to be able to have done that, because it just gives you the confidence that you need. Like I get a lot of people that are really afraid, and they watch too much negative news, which is probably 95% of the news. But I think maybe 1 out of 20 stories is positive. And if the news media gets upset over me saying something like that, well, then start running more good stories. I know I'm probably exaggerating, that it's probably more like 10%, or 1 out of 10 is good. It might be 1 out of 5. It's definitely not 50%. But anyway, that's one thing I really wish would happen, because I know there are enough people out there that would be attracted to positive news as to just gloom and doom. In my business, in the industry that I'm in, managing money, there are going to be good times and there are going to be bad times. And markets only go up a small percentage of the time more than they're going down. So if you hadn't heard that before, well, now you have. And you got to prepare for that. It's all mental. And if I really broke the math down, to asset allocation, basically how much am I going to put in stocks, bonds, and how much am I going to put in cash? You probably know enough math to be able to do that by the time you're in the 7th or 8th grade. Nobody's just explained it like they should. And I get it. My industry, they want to make you think, it's 10 times harder than it is so that you hire them. Well, I found that the more somebody understands about how things work, the better of a client they become, because they're not as upset when they don't get surprised negatively. That's kind of the deal. It doesn't matter what you do. If you're going to be in financial markets, there's going to be turmoil at some point in time. If you weren't expecting it, that's because somebody didn't tell you. And so I try to cover all that stuff. I can't express the number of times that I had been surprised. So having this much experience under my belt really helps a lot. How many times I was surprised that companies weren't being completely truthful with their data. That's really hard to do. And that's another thing. The only way you can protect yourself against that is diversification, having a bunch of stuff. And again, I've been using this platform through Fidelity, and there are a bunch of firms out there now that have really good platforms and can do things that are extremely similar to what I'm doing. But anyway, you sit down, you try to figure out how much volatility you can really take. In other words, what kind of risk taker are you? And then your advisor should be able to match you up with multiple choices on what you can do with the money. Might be stocks, might be, if you like stocks, I love stocks, so yeah, I've got a bunch of my money in stocks, individual stocks, but they're calling the shots now. And quite frankly, for me to pay for the software that it would cost to be able to duplicate just that one strategy is just not worth it when I've got those guys doing it as little as they charge for doing that. So it's a big deal. And I just started working with these guys, less than probably about a year ago. After all this time, I finally gave up the ghost and said, yeah, I'm going to just go ahead and work with these guys. And the ETFs that we used before, I still have the old model, and I didn't take all my money out of it. I really don't do that kind of stuff. But anyway, I picked the best models out of the ETF market using what I knew about how the portfolios were constructed. And if you're out there and you're just trying to get started, let's say you're in your first job, okay, there are things that you're going to want to look for, certain key factors that when they include them in their model, over the long run, those portfolios have a tendency to do better. And number one thing is sales growth. You would think that would be a no-brainer, right? Well, yeah, of course, if the sales are growing. Well, the S&P doesn't work that way. S&P doesn't care how much they're selling. The S&P looks at two things: capitalization, how big are they? And by the way, when you're looking at capitalization, how fast is it moving? So that's why it's so volatile. By the way, it fluctuates. It is all over the place, and that's why. Size and speed, baby. And yeah, it's a Lamborghini, that's for sure. And sometimes it kind of goes unhinged. But anyway, so the differences between the various funds out there are only several thousand of them, are going to be how they're taking into account, well, it could be a lot of things. It could be if they're outside of the United States, that's one thing. If they have any sort of fixed income, that's another thing. The list goes on and on and on and on. And literally, there are several thousand. So it's one of the reasons I still have a job, because the choices are so inundating. It's just, paralysis through analysis. I see that all the time. And there are a lot of really brave young people that they read an idea. Like if I give you the description of this one fund that I'm using, I'm not going to do that, by the way, because I won't name it because I don't want to be responsible for people going out buying it, and when the next big correction comes and they instead of hearing me say, look, this fund fluctuates a lot, they forget all that when they look at the performance. They don't pay attention to the volatility. And then when it's down big time, because the markets are all down, they're going, hey! And, well, I have to avoid recommending specific products because of that. That's why. And I know everybody that, by the way, and everybody that's going to do that, which it's going to be few. There will be just a few people that'll do it. But every single person that is going to do that is also going to say, but I didn't know. Well, I told you, but you weren't listening. So anyway, I'll quit venting now. See, it's actually pretty good after all these years. I think most of my clients know, and I know they do. And I guess it's funny, my phone barely rings, which is rightly so. It shouldn't, unless there is an an emergency, or maybe you're changing jobs. You want to switch you want to take your 401k, put it in your IRA. If you may have inherited money, you may want to start a fund for your kids, your grandkids' college. That's been very popular the last few years. So I'm like, wow, man, I had to pay for my school myself. And then everybody goes, oh, yeah, you were on a football scholarship. I have never had to work that hard again. See, I'm not that big. I'm a big relative to normal people, but not the Division I football players. and I was your average white kid. Maybe above average, but the above average part was desire. It was I could not stand getting beat, so I would do anything in my power to resist that, and my body's feeling it now, and it's always felt it, since then. But that's a tough way to go through school. So anyway, I hope you get help from your parents. Back in those days, it was wild. The number of kids, especially from this area, that was at the turning point of an era in the greater northeastern Ohio. A lot of the steel companies were slowing down big time. And an awful lot of people worked for one of the steel companies, one of the people that was a supplier to the steel companies. And then the automotive industry was just astronomical, and you had a whole bunch of really small companies that made parts for them, and they would be employing a lot of people, and never mind the people that worked at the steel companies and the big three, the automobile manufacturers. You don't hear anything about that anymore, and it is mind-boggling to have watched that whole transition the way that I have. And this is one of the reasons you want it. You want to be learning about investing. I don't care how secure you think your job is. At some point in time, there's a really good chance you're going to end up changing jobs. And it's probably, as you get older, there's that age bias that people have, and the fact that you're making a whole lot more money than somebody in their early 30s that can probably do the same job you can, maybe quicker than you can, and is charging a whole lot, or has a lot lower salary. So those are all real things that people end up having to deal with at some point in time. And that's one of the reasons you want to have an advisor. Are you getting the biggest bang for your buck? I'm going to make a offer here. I'll even take a look at your 401ks, even though I'm not going to be managing them. But I'll take a look at that for you. I've been doing this for so long, I could do it in my sleep. But you know what I just realized? I didn't give the the phone number out here today. It's a little late now. I'm looking at about 2 more minutes before the show's actually over. So anyway, tune back in next week, or just go to my website, bullingtoncapital.com. You can also get a copy of this show on YouTube. Just go into Bullington Capital. It'll be there. But give us a call. If we can help you, we will. And this is the same tone of voice I use all the time, so you don't have to worry about somebody trying to do a hard sell. Anyway, I appreciate you listening. I hope you guys have a really good holiday season. I'll be back next Saturday. And other than that, have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.